So if you look at the inflation landscape in Australia, this has evolved notably since March. And in March 24, earlier in the year, the CPR number was around about 3.6% on an annualized basis, which was a quarterly increase of about 1%. In October this year, the annual inflation rate had moderated quite a lot down to 2.1%, which is nicely in that RBA band, although this hasn't gotten them all that comfortable because underlying inflation, which is measured by the trimmed mean, increased to 3.5%, which was up about 30 bips from the September month end. So this shows us that there are still these persistent or niggling inflationary pressures sitting in certain sectors. The RBA acknowledged that there are mixed signals coming through and noted that the headline inflation, which is currently sitting within its 2 to 3% target range, is a good thing, but their worry was more around the underlying inflationary pressures. So our call earlier in the year around the US interest rate was proved to be pretty spot on. They have commenced their cutting cycle and they've been quite aggressive with 50 basis points and 25 basis points since then. What we really believed about the US, and we think this is very true in terms of the commentary we're seeing out of the marketplace, is that their interest rate bill of $1.3 trillion was just too high, in fact, the highest line item in their budget. And as a result of that, not so much their thoughts around the economy or inflation, they really had no choice but to reduce rates and just try and bring pressure on and bring that interest rate bill down. It's going to be really interesting to see what happens next year when Trump comes in post 20 January and puts his cost-cutting team of Musk and Ramaswamy to work during the course of the year. Within the credit fund, as a result of all of that, what we're thinking at the moment is that we're very interested in picking up fixed rate exposure across the portfolio because we think that the movements are likely to be that rates start moving down. At an economic growth level in Australia, we've seen growth continue to decelerate since March. In the March quarter, the GDP numbers increased by a modest 0.1%, which resulted in an annual growth rate of 1.1%. By the September quarter, GDP growth remained subdued at 0.3%, which brought the annual growth rate down to 0.8%, which is actually the lowest we've seen since the COVID-19 affected December quarter in 2020. This is primarily due to weak consumer spending, as we've talked about a little bit earlier. Higher interest rates dampened consumer demand, which led to stagnation in household spending. This was partially offset by the government expenditure column. So government spending and public capital investment have been the primary drivers of GDP growth over the last 12 months, which indicate a reliance on public sector activity to sustain economic momentum. Our thoughts is that's generally not a good thing to see within an economy.